All right, folks, a little test here. Can everybody hear me okay? Hello, folks. Hello, hello. All right, folks, I'm a former Air Force officer, active trader since the 70s, still trading today. Former member of Chicago Mercantile Exchange. I have three books, Winning the Day Trading Game, The Markets Never Sleep, and Trade to Win. Uh, pretty pretty extensive career in this game of trading, learned a lot. And, in that process, you lose a lot because you're trying to figure out the best plays to make. And so when I focus on the market, I always focus on from a big picture down to a smaller picture week by week. And I feel like that's a good way to look at things when you're trying to figure out how to grow your account. So, uh, there's risk involved in trading. I always talk about that. And without a doubt, past performance is not indicative of future results. Now, our YouTube channel is free. We're trying to build a place or resource that you can go to and find out things that I call them proprietary, in the sense that there's things I've learned through experience that I can share with you that will make you better at this game of trading, maybe keep you from losing money like so many new people do lose. But right now, we've got over 500 people in this new channel. I look for it to grow, and I will do these trainings from time to time as schedule permits. So I want to thank everybody for being here and participating in the first one, and they'll get better as we get deeper and deeper into this game of using YouTube in conjunction with the Zoom. So I want to remind everybody we now have a customer service live from 10 to 1 every day. You can go there and ask questions. I think of this as a place that you keep on your computer between 10 and 1. And if you got a question about where some video is you're looking for, or what we said on a certain trade, or information that will be right at your fingertips, but you just can't think about where those fingertips are located, then this is a really good way of doing things. Okay. That's uh that's our approach. Now, this lesson is part three. Most people today are really interested in options. Well, I happen to be somebody who's traded options for a lot of years, and I'm still breathing, still above ground, and still learning better ways to do it. And one of those better ways is what I'm working on right now, is a project I call the 25-cent trader. And by the way, you'll be invited uh, when we go to a live market today at 3:30, which makes it pretty neat. So let's take the option information and go through some slides to grow your account. All right, strategies. You got to have a strategy if you use an option. There's all types of options, all types of combinations. You start from the basic strategies, well, where you think the market's going up, you want to buy a call option, or you think the market's going down, you want to buy a put option, and you develop rules and guidelines to follow. Now, I will tell you, from time to time, you need to adjust those rules and guidelines if they're not giving you the results you're looking for. Everybody here is different, and I'll tell you that. Also, you need to know how to repair what I call a bad option trade. And I've got a video that I put together to help you do that and save you a lot of time, a lot of effort, and really a lot of pain and suffering if you watch that video. It's very good on turning lemons to lemonade. Now, what you're looking at is something I had to put in front of me back in the day when I was learning options. I couldn't just get, it was very foggy for me to understand options themselves. And so I had to relate it to buying stock. And if you buy stock, you make money how? If it goes up. Or shorting stock or selling stock, how do you make money? If the stock goes down. And I always tell people it's real simple when you think about it. You want your B's, which are your buys, less than your S's, which is your sells. And it really doesn't matter what order you do it in if you think of it that way. But you got to have a pair of twos at the end of the day, meaning a buy has to equal a sell to flatten out that position. And the time in between is known as a day trade, an annual trade, swing trade, all the different terms they put on it. But if I was you and I was new, I'd print this slide off and I would keep it at your desk. And every time a strategy came out, I would plug it into here just to make sure you have the conceptual picture of what you're trying to do. Because it does get confusing if you don't. So, simple strategies. Now, if you're playing what I call debit option spreads, these are directional. For example, if you look at DJT today, we did a directional play where we thought the stock would go higher, which it did, and we bought a call option, and then we sold an option at sort of the target that we anticipated at the time we bought it. Well, how did we get paid? We paid a debit, meaning they took money out of our account. In this case, it was around 25 cents. And then we sold that debit spread and brought in money, which was a credit. We compared our sell to our buy. So we paid 25 cents and got 39 cents. So we took, about 14 cents off of a 25-cent option. Okay. And that's what we did. Now, if I thought the market was going down, I would do the exact opposite, meaning I'd buy put and then I would sell a call below where I bought the put, and that would be a debit spread, and I would make money only if the market went down. So you still get paid because of the same direction. The odds of doing debit option spreads, whether you're long or whether you're playing to the downside, are a lot higher if you sell that option up there at target, because now instead of having a pure call option or pure put option in place, you've got a little cushion there to give it some up and down movement before it makes the original intended move. And that's why I like spreads. Now, spreads are tricky, but you've got to learn one rule in spreads. And you have to know some simple math. Let me explain. If the spread width is $5 on your spread, you do not want to pay more than 50% of that width, which is if $5 is divided by 2, you can do the math in your head, you wouldn't want to pay more than $2.50 for that spread. A $5. If it's a $1 spread and you were trying to make a debit call spread, you wouldn't pay more than 50 cents. Or if it was a put spread, you wouldn't pay more than 50 cents to the downside. Now, I will tell you to try to use expiration, okay? 3 to 6 weeks out. That will minimize, that expiration date will minimize some minor fluctuations, okay? And I will answer your questions when I get to the end. Let me get through all the slides, but I really believe if you will practice the simple, hey, I think the market's going up, I want to buy a call. Well, once I buy that call or can do it together, I can sell a call at my anticipated target, increase your odds, spend less money doing it, and give you some downside if you're off a little bit on your time. Now, credit spreads are a little different. This is where money comes in, but it creates an obligation for you. For example, if I thought the market was going lower, I could sell a credit spread, okay? And all it would have to do is stay below that strike. A good example would be if you had a stock that you thought was coming down, you could sell a call spread up above, sell the call, and then buy a call to protect yourself. And you would make money two out of three ways. One, if the stock went down like you thought, or number two, if it didn't go up to where your strike had initiated the sale, you would make money at the expiration date. Now, put spreads are bullish transactions. And when I say that, meaning you're selling a put at a level that you believe the stock will not go below that level by expiration date, or if it does, it will not stay there. And you're still doing the same concept, but you flipped it on its head, meaning that you want the stock to either go up to make money, that's one way, or not go low enough to get in the money, what they call it, which will cause you some heartburn as you have to buy it back for more than you paid it and cause a loss. So I love doing call spreads and put spreads. I like to do it together. And that gets into pairing a credit call spread and pairing a credit put spread. That is what's known as a iron condor. One of my favorite strategies of all time is an iron condor. Why? Because I'm working the time side of the market twice as fast and I got less risk by doing an iron condor. If I'm good at doing this and I stay below my call, the short call, and above my short put, I get to keep all the money I sold it for. And that's fun to do, keeping all that money. Now, if I'm doing call spreads, meaning selling spreads, I want as short a time as possible. Why? Because the closer you get to expiration date, the steeping of the curve is a lot sharper. It takes a lot to be an option seller if you got it positioned correctly. Even when it goes against you as an option seller, you got the odds in your favor very strongly. 2 out of 3 times, you're going to be making money. Worst case, just mathematically. And then you throw a little finesse in there, you can have some pretty high, what I call accuracy rates. And it sort of fits your personality. If you're okay with making, 4 out of 5 your way, and that makes you smile, I'd say you're a call seller and a put seller. Now, again, expiration date needs to be as short as possible. That's the value. And just make a little side note here. That's why I love TNT. Typically in TNT, I will do option spreads within 1, 2, 3, or 4 days to expiration. Why am I willing to do it in TNT? Because I have direct access to you to say if the market changes, we need to make an adjustment. I do that all the time. Short and option spreads. If you can get a 1 day out or 2 day out and can stay in the game for a couple hours, you're going to make money. And you really look like you're smart, but really what you're doing is playing a real tighter time curve using our market timing approach. Now, print off the following chart, and I'd put this one again next to the other one. This chart woke me up to buying options and selling options. Notice the steepness of the curve inside of 30 days. Look how that thing really rolls down after 30 days. And you get inside of 10 days, 5 days, or like in our weekend side hustle, where we're only exposed for usually a maximum of 2 or 3 days, the odds are so strong in our favor because of that time loss that happens. Where you get in trouble is that if you have rapid movement during the time you're taking that obligation. But look at that curve. When I first saw that, I saw it in a subscription I had with Value Line. You might have read about it. They're still around today. And they had that in there talking about options, how much options expire, and why selling options was a high odds way of trading options. And I agree. And then you look at that and say, well, there's limited times that gets outside of a normal up and down movement, and those give you some opportunities also, and we'll talk more about that at 3:30. But this slide here is so valuable, I would keep it right in front of me to remind you anytime that you venture on the long side, you got to worry about that time curve. Now, limits to lemonade, you got to know how to hedge. If a long call, we can always turn the trade into a call spread to lower our risk. I do this quite often. If I'm doing a spread on an option, or I don't start out with a spread, I'll go in with my long. And then maybe if my timing's off at the same day I put it on, I will go in there and sell the call against it and match up the money I outlaid by bringing it back to me, because it really doesn't harm my basic position. Let me explain. Let's say I'm long at $1 on a strike, maybe an Apple going higher, but maybe Apple quits going up that afternoon and goes down. Okay. Then maybe my option goes from $1 to 80 cents. And my target on that Apple strike was about $4 or $5 up during the time frame my expiration date had projected. Well, I can go out there and sell that call and get my 20 or 30 cents back that I paid on the front end, and now I'm back in the game for day two. That's what I like about doing that, because you can always, on a call that you buy, you can always sell a higher up call to turn the trade into a more credit call spread. There's other things you can do also. I developed a strategy called the buzz fly. The buzz fly, I'll usually go out generally 30 or so days, and I will take an outright call. Let's say it was at $4, reduce the price of that by maybe $2. Now I got $2 exposed. And then at my target, I will double sell the call and bring in another dollar. And so now I got $1 exposed on a long that I would have had $4, meaning I could have 25% of my outlay and still make the same amount of money. The buzz fly is one of the brilliant strategies we have. And that's, if you want to know more about that, you can go into, our subscribers can go into our Options Made Simple course. And I forget which lesson it is, but it's right there called a buzz fly. Now, if we short a put spread, we can always, if it's going against us, also go up and sell a call spread to turn our trade into an iron condor. Again, another way to mitigate your market timing. I love all these strategies, and they're all available to you, but you got to take some time and learn. It's not rocket science to learn about the different things you can do, especially we got resources for you to learn that and help you manage these options. When trading options, expiration date and the time you're in the position will determine your success or failure. I use a general rule of 72 hours, and I do it by time because I can't watch all these options as close as I used to could in the old days. Pretty busy. I'm pretty busy trying to figure out what's next on the agenda. And that 72 hours is a wake up call for me to look at an option I put on and decide, hey, this thing's a dud, get out, take a loss, or hey, I'm off a little bit. There's more hope here and more odds in my favor if I want to modify it after 72 hours and stay longer. And if I made a real good decision, the trade's going great, I can ring the bell on some of it or all of it. If it's a dud and can't do anything about it, then I need to take action, belly up to the bar and say, get me out and move on. There's always better trades out there. Now, a lot of times I'll look when one gets really away from me and see how much fruit's left over. Let's say I paid $1 and the thing's worth 20, 30 cents. I'll take that 20 or 30 cents and buy a different expiration date out into the future because I feel like that I let it get away from me. I might as well have some of it come back to me by taking that last little piece and buying a different expiration date, usually staying with the same direction. I'm not required to, but usually staying with the same direction I originally thought about why I made the trade in the first place. And that's just something I do every now and then. I don't make it a habit, just I do it every now and then. Now, you can review the Options Made Simple series on my DTI members area portal. Sign in with your username. Go to members.dtitrader.com/resources. And again, if you forget this and you're sitting there and it's about 10 o'clock on a trade day, go to that website, dtitrader.com/help, and get somebody to tell you where it's at. I want you to have as least amount of friction. Trading's got enough friction in it, doesn't it? Least amount of friction when you're trading. So, Customer Service Live will help you. All right, let's go to a live market. Let's talk about today. Let's bring up, if we can, the QQQ for the day. Now notice we look at the daily there. What do we know? And I'm going to ask some questions. And Jonathan's going to answer these questions. This is what I think when I look at the QQQ. Jonathan, where was the high on Friday with the QQQ?
All right, the high on Friday was 444.31.
And what was the high today?
The high so far today is 444.09. Happened the first 30 minutes reference bar of the day, cash market.
So thinking about that and having a picture in my mind, the QQQ came up to Friday's high and then backed up, correct?
That's right.
All right, what was the low on Friday?
I got the low on Friday down at 440.5.
And what was the low today?
So far, the low today is 441.65.
So let's just plot that one out in our mind. We had a low of 440, let's call it. Today's low hasn't penetrated down there. In fact, if you take the current price of the day, which is 442.72, okay, if you take that and do that, where does that put the current position relative to Friday's trading? The 442.73. Peter just answered, in the top half. So when you put these 2 days together, today's action is sort of bullish, is the way I look at it. Okay. And that's how you do it. Okay. That's how you do it. Exactly what I just described. So then let's go to the NASDAQ futures, which is a leading indicator for the QQQ. And Jonathan, why don't you go to the 30-minute, if you will? Tell me where the top of our Genesis bar is on the NASDAQ futures.
Top of Genesis, this white bar my candle is over right here, is 18,296.
Okay, tell me the current bar, tell me the top of it.
Yeah, we're
Which
forming
is
reference bar
RB4.
4. Yep. And the high of that right now is 18,294.
All right, folks, you can take this one to the bank, in my opinion. If that S&P gets above 182.96, then the QQQ is going to rise and go up again and test that high of the day. And that can be traded with options. And if you're going to trade options on that, you would probably use a QQQ option. If you're going to trade futures on that, you would use the NASDAQ futures. In fact, I will probably do the futures because I like futures. And that's just something, what's this? Easy entry, easy exit, if that event occurs. So this time of day, keep your eye and see if we get above that 96 area to let you know where we're headed. Analyzing, interpreting markets, what I do. And I do it at each of these reference bars that we taught you about last class. And Peter, very wise to talk about the positioning of the current price versus Friday. I want to look at another stock real quick the same way. Look at the American Express from Friday. What was the high of American Express on Friday?
Yeah, on Friday, American Express made a high of 243.5.
On Friday?
Yes.
Okay. And then go back one day. What was the high on Thursday?
239.38.
Okay, 239.38. Has anybody ever heard the term gap? You had a gap, a breakaway gap on American Express into Friday and into the day. You ran into resistance up there at 293. Let's just call it 93.55. So what the market is telling you then is when American Express finishes doing its backing and filling right here, and I'll call it backing and filling, it's going to go up and test that 243.55 area. And that's how I believe we get to 250 at some point, if we can get above that 243.55. And that's why I want to look at American Express. So this is how we're wrapping up options. And you think about today, we got one more class to do, and then we're going to go live at 3:30. And I've got to put on a 25-cent trade later on. Anybody got any questions? Let me see if there's any questions. Deborah would like me to talk louder when I do the TNT updates. She says that it's too low. Can you adjust the volume from your end? I don't know. I didn't, I usually listen to it, and when I listened to it on this computer, the sound sounded okay. But I can talk louder. I'll try to remember to talk louder, Deborah, just for you, okay? I'll try to do that. All right. Yeah, you seen the term opening and closing? Dean asked. Opening means whether you buy it or sell it, is it a new transaction? Okay. And a closing means you're closing out of a previous transaction. That's the way I think about it. That's very important with options because remember, you got to have two options, right? You got to have two options. No, Don, I haven't adjusted anything on the American Express. Day's Monday. I'm gonna let it play out, okay? And we'll look at it tomorrow if I need to. Great question. All right, Jonathan, what else you got?
That's it for now. We'll be back, a short break, back at 2:15.
And what's our subject at 2:15?
At 2:15, the subject line is take the information to grow your account.
There you go. That's what I was hoping for. All right. Everybody take a nice break. I'll see you. And I'm going to do a test over in TNT and see if it's me or got to do something on my end settings wise. So let me know when we come back if you heard me loud and clear.